I'm one of the three founders of Tidal Petroleum and the sole founder of Tidal Group. I graduated from Texas A&M back in 1992 with the focus on law, securities law. I moved to San Antonio because my fiance, of course, was from here. She had an uncle that was a retired oil and gas guy. He called me one day and asked me, why don't you come over? We'll start a little oil company and we'll drill a couple of wells. Our first well was a vertical well. We bounced around from doing oil wells to natural gas wells because gas prices were high and then oil was low and oil was high and gas was low. So the oil is kept in the pore space of the rock. So you can drill right through the Eagle Ford Shale, and until you frack it, you're going to get nothing. You've got to break that rock up to let the oil come out of the pore space to come to the wellbore to produce. It's a long process, when you're looking for new areas. It starts with cursory search of where other people are drilling. If we see some older production that we think can be re-stimulated, we'll start looking in that area.
Welcome to the Executive Connect podcast. We have Mr. Lee Novikoff from the Tidal Group here today. Lee, thanks for joining us.
You're welcome.
Can you give our viewers a high level of your, how you got into the oil and gas business and sort of a brief history of time there?
Sure. Let me go way back to when it started. I'm one of the three founders of Tidal Petroleum and the sole founder of Tidal Group. I got out of, graduated from Texas A&M back in 1992 with the focus on law, securities law, investment related. I moved to San Antonio because my fiance, of course, was from here. And the goal was to go to St. Mary's Law School, did the LSAT and everything else. And she was still in school, so I got a job to support her until she got out. And then in the meantime, she had an uncle that was a retired oil and gas guy. He had a partner that had been in the oil and gas industry through the 80s and into the early 90s, and they had both retired. And we got to be really good friends, and he called me one day, and this is back in 93, I think, going into 94. And asked me, him and his old partner had a couple of leases that were going to expire. And he had this idea of, hey, why don't you come over? We'll start a little oil company and we'll drill a couple of wells, some shallow stuff. And of course, I'm 23 years old and my ambition and, my wheels are spinning. And my thought was, well, let's do this. I don't know anything about oil and gas. You guys do that. Y'all handle that end of it. I'll open a brokerage house, the Tidal Group, and get a license. Back then, it was NASD that was a regulatory body, not FINRA. So opened a broker dealer and hired some brokers and started managing money. And I'll handle that end, you handle this end, and away we go. So they're whatever they they were like, okay, fine, we just want to drill some wells. Well, that was over 30 years ago. So, in the interim, it morphed into quite a bit more than that, of course. I was a liaison for both companies. I ran the broker dealer solely. And the oil company, I was a VP at the oil company, and I handled all of the, everything between the two. As things progressed, I ended up taking a bigger and bigger and bigger role in the oil company. And one of my two partners, they were both, 20, 22, 23 years my senior. So one of the partners, he's passed away now. We bought him out, me and Pat, we bought him out probably 10, 12, maybe 15 years ago. And about 10 years ago, Pat was ready to retire. And before he retired, he turned everything to me where, I took over the presidential role, and I've been, running it ever since. I bought Pat out probably eight years ago, maybe 10. And here we are today.
All right. Well, so you kind of come at things from, it sounds like you wanted to be a securities attorney, but there was a better opportunity that showed up in life. And that's sort of like your point of view on things. And you had to learn the oil and gas business from your partners as you went along.
Ready to lead smarter and invest wiser? On the Executive Connect podcast, we unpack executive strategies for wealth and influence. Hit the subscribe button now. Don't just watch, act.
Well, and it's not just from them; it's from doing it. I know more about law now than I would have than if I would have gone to law school. I feel, we have, or I employ on retainer 12, maybe 14 different attorneys. They all have specialties. So when we're dealing with the regulatory element, you've got to have a securities attorney. When you're dealing with, oil and gas minerals, you've got a title attorney and a mineral attorney. You've got general counsel. There's so many different things. One that specializes in the Railroad Commission filings, and then there's not one size fits all in any profession. It's very similar to, you go to your doctor, and if there's something wrong, he's going to recommend a specialist. Law is exactly the same way. Everything you get into, you're going to have somebody that's their focus, and that's where you need to go. So, I would have greatly restricted my knowledge base if I would have stayed solely just in the securities realm. And, hindsight, I wouldn't change the thing.
Right, for sure. Well, it sounds like you guys are focusing mainly on the Eagle Ford Shale at this point, but I know you've done projects elsewhere. Can you kind of just walk us through your journey there and how you landed in the Eagle Ford Shale as sort of your focus?
Oh, back in since we started back in '94, our first well was a vertical well, South Texas, and we've been drilling South Texas ever since. And our focus for our clientele base was speculation. It was vertical wells are risky. You might hit 1 out of 5, and 2 or 3 out of those 5 are going to end up being profitable. But they're very inexpensive. So, one well, if it's good, can come in and make you 3, 4, 5 to 1 in the first year. The issue with that is you've got a lot of wells that don't work, and you've got a lot of dry holes that go along with it. So, we bounced around from doing oil wells to natural gas wells, because gas prices were high and oil was low, and oil was high and gas was low. So we had the flexibility to really go into different areas. But from an investment standpoint, in a financial portfolio management type standpoint, the goal of a client's account is to where it gets to the point where the funds that it's generating will afford multiple more investments. So you'll have somebody come in on the first couple of investments, and they'll take a nice tax write-off first year. Income starts, and a lot of the income, 15% of the income is non-taxable. And then with the residual, if they roll it back into another program, it gets written off again, and there's no tax burden. And that would work fine, but on verticals, you get to the point where you're ready you've made enough income to drill another well, and then you drill a dry hole.
Right.
And you're starting all over again. And that was what we battled up until 2008, when the shale boom started. I mean, the Eagle Ford Shale was really one of the starts of the oil shale. And Petrohawk discovered it or started it. And it was, the whole revolution started by one component. One is called a frac plug. Because, we've been fracking wells since the 60s and 70s, but it takes, there's only so much power that you can push down the pipe at the same time. So you're limited to how much of the formation you can stimulate. Now we can easily do 180-foot sections. Back in vertical wells, well, your formations aren't that thick, so you're stimulating maybe a 30 or 40 or 50-foot thick formation. That's not hard to do. But when you're drilling these horizontal wells, you might have 10,000 feet. Okay. And in the past, there's no way you could stimulate 10,000 feet. So the invention there was this plug where you'll frac 180 feet, stimulate it, put a plug, do the next 180, do a plug, do the next 180, do a plug, do the next 180. So you'll have, our current prospect that we're going to start fracking next week is 88 frac stages. It's 4 wells across 88 frac stages across 4 wells. And, up until, this technology change, that was impossible. There was, the Eagle Ford was there, but it wasn't productive. Nobody could figure out how to get any oil out of it. And that changed the entire landscape here in the United States.
So, yeah, can you, our listeners may not be familiar with all the technology and sort of the evolution of that. I mean, has the horizontal drilling technology been around for a long time, or like what specific pieces of technology made some of what you just talked about possible over the last however many years?
Are you a high-income professional looking for smarter ways to protect your wealth? The Texas Freedom Fund gives you the opportunity to invest in energy assets leveraging proven fracking technology and prime access to global markets. With strategic oil and gas investments, you can build real wealth while benefiting from tax advantages under laws dating back to the Reagan era. Take control of your financial future. Visit texasfreedomfund.executiveconnectpodcast.com.
Franklin.
Right.
Yeah, that's it. We've been horizontal drilling's been around for a long time. The Austin Chalk boom back in the 90s and 80s was all horizontal drilling. That was very productive. But the difference is that did not need to be stimulated. It was a big limestone section down, in South Texas, and it has cracks in it. And oil's migrated up from the Eagle Ford Shale into these cracks. And, they will go, let's say the cracks run like this, up and down. Well, instead of drilling vertical wells trying to hit these, they would come down and they would drill sideways. And they would several. And that's what made it productive. But it did not need a stimulation. Now, the shale is, the oil is kept in the pore space of the rock. So you can drill right through the Eagle Ford Shale, and until you frack it, you're going to get nothing. You've got to break that rock up to let the oil come out of the pore space to come to the wellbore to produce. So the ability to frack a long lateral, if you just drill a vertical well through the Eagle Ford Shale, your shale section might be 50 to 60 feet thick, and you've just fracked that, you're not going to make any money. It's going to be terrible. But if I turn and I drill 10,000 feet, I frack the entire 10,000 foot interval. Now we're talking about some good recovery rates.
Okay. Yeah, and I know that this new technology and drilling in the shale formations is it's been pretty revolutionary, at least for domestic production in the last however many years. Can you talk a little bit about how this plays into the domestic production here and, America's energy independence and, how much we're producing relative to other countries now, which I'm sure a lot of people that sound like they know about it is all.
Well, I mean, right now, we are producing more than we're consuming. And it's because of shale. It's because of the Permian, which is completed and produced the same way. It's because of the Eagle Ford, the Bakken shale. All of this has come from this technology, and this is us producing and extracting oil from our resource rock. It's limited. Our energy independence is going to last about this long.
Right.
It's not there forever. We're drilling the hardest, most expensive formation to drill, which is shale, and to stimulate. Nobody else is doing that. We're scraping the bottom of the barrel. We were able to scrape it very, very well, very productively at this point. But it's limited. The Eagle Ford now, technology changes and improvements have helped our recovery rates, which have kept our production going. But most of the core areas are already drilled. Most of the core areas in the Permian are already drilled, which is where all this increased production has come from over the last 10 years. So it's getting harder and harder and harder and more expensive to find. I don't see this continuing unless, we find some new undiscovered huge formation somewhere in the United States that nobody knows about, or if, the light bulb goes on somewhere and somebody invents some new incredible technology that's going to increase our recovery rates in these older wells. They have improved over the years from a maybe a 2% recovery in the Eagle Ford when we first started, to we might be as high as 6 to 8% now. But still most of the oil is left in the ground because it's we can't get it out.
Yeah, so to that point, there's probably a lot of factors that go into projects that you look for, So can you walk us through, how you identify a new drilling location, what's the anatomy of a deal, and then, minimum property size and how you negotiate the lease and how all that goes together. I know a lot of folks are watching this new Landman series on not HBO, whatever. I think it's on Amazon or something like that, Paramount Plus.
So it's on Paramount. I watch it too. I agree. It's extremely entertaining. It's grossly inaccurate, but it's very entertaining. I don't know if there's some of the times when he gets on a rant, and he talks about windmills or whatever.
Right.
That's great. Some of that is accurate. His take and his point and things like that. I really get a kick out of it. But all of the drama, the pump jacks blowing up and all this stuff, none of that happens. Landman doesn't have for instance, here's the biggest difference. He's supposedly the landman. And the rig blows up, the pump jack blows up, and he runs to the truck and gets a pipe wrench and goes over there and fixes it. Well, my head of land, basically my Tommy from my company, is a blonde-haired Polish woman that's as tough as she is, that drives a Porsche, and she lives in Denver.
Right.
It's not like that, because they're negotiators. I mean, she doesn't have anything to do with a well pumping or producing or workovers or anything like that. She's out there hunting prospects, day in and day out, dealing with landowners, negotiating leases. That's what she does. You got to go to the engineering side when we're talking about maintenance of wells and issues. And we've never had any issues with cartels, but that's pretty entertaining as well. So that's some of the differences, and not that it's TV. It's TV, and it's a great show. I enjoy it. I do. Watched the finale last night, actually.
I haven't watched
But
it.
the method of ours, were, I guess, the evolution of a program in from start to finish. It's a long process, when you're looking for new areas. It starts with just a cursory search of where other people are drilling. If you see a lot of activity in one area, we'll start looking around in that area. If we see some older production that we think can be re-stimulated, we'll start looking in that area. And when I find an area that might be interesting, the first thing that I use, it all comes down to a spreadsheet. It's all financial. It's like,
Right.
Okay, what are these offset wells producing? What's it going to cost us to drill out there? What's the extraction rate? What's my bang for my buck? How much oil per foot per cost can I get? Is this going to make us any money? And if it, I would say 8 out of 10 that I look at never get past there. If the ones that do, then we go to the next, the next level, which is a cursory search of, are the minerals available? Are the minerals open? And then if they are, the geology is working along the same time to look for faults and sand thickness and things like that. But we'll start talking to the mineral rights owners, and then we'll see what they want as far as leasing goes, and we'll see if we can't make a deal. Now, a lot of these leases at this point, when we're talking about long horizontal laterals, it's not just one mineral rights owner. There's several. We have had areas where we've had to put together 70 different mineral rights owners to make one unit, for a drilling prospect. And it takes anywhere from a year to some over 3 years. I've got some programs I work in where the first leases, I took 3-year leases, and I've had to extend those leases because I don't have everybody else. and every lease, let's say I'm putting together a 700-acre unit. Within that 700-acre unit, there might be 15 or 20 different parcels of land that I have to put together to make this unit. And every single one of those parcels might have 15 to 20 different mineral rights owners, because the great grandfather owned it or grandmother owned it, and she passed and left it to 4 kids, and then some of those kids have passed and left it to 4 other kids. So it's a lot of work that goes along with chasing who owns the minerals, when were they left, were they documented correctly. It's a lot of legal work to put a mineral lease together. And then once that happens, we create a security that is, we're going to drill 4 wells on this parcel. It's going to take us $50 million to drill these. We'll break that up into shares. We'll bring the shares over to the brokerage house, and then they get marketed, to our clientele base. And we've got clients, and I think we're licensed in 47, 48 states. And we've been managing clients' money since, the early 90s. And we've got different clients that are looking for different things. And that's how.
So can you, I don't think people, or maybe some of our listeners, are super familiar with working interest versus mineral rights owners versus the leaseholders, and kind of how the pie gets divided up between those folks. Can you maybe walk us through how that normally works? Or I'm sure it probably varies a little bit by project, but the general structure is probably largely the same.
Yeah, it is. I mean, there's 2 things that you have to realize in oil and gas. There's 2 different types of interest. You've got mineral interest, and you've got revenue interest, or working interest, I should say. Working interest and revenue interest. Working interest is the cost of development. It's what it takes to drill the well. Revenue interest is what the well pays. So if we go lease a parcel of property, and let's just say it's from one person, well, they own the minerals; they're theirs. So if we want to extract those, we have to give them a piece of the pie. In the Eagle Ford, generally, it's about 25% goes straight to the mineral rights owner with 0 cost. So he gets a 25% mineral interest ownership, overriding royalty on whatever the wells produce, and he doesn't have to pay a dime to develop these minerals. He doesn't have to pay drilling costs. He doesn't have to pay anything because they're his. He owns them. They own them. When we come in, we're paying all the costs. Okay, 100% of the cost, and we get 75% of the revenue. So that's the structure. And the company will normally will offer a 70%, since we're spending the time to put it together, the risks and all this. We'll take a royalty interest as well, and we'll offer 70% to the clientele base. We get 5, and then we buy working interest just on the same basis as they do as well. We'll put partners in the rest. We'll all go drill it, and what it produces, it produces.
Right. Okay. Hey, can you walk everybody through one of the main things that attracted me to this sort of investment was the tax benefits. So, believe it or not, I grew up in Austin. I've been here almost my whole life. And I've never heard of this, which is, I think people have a picture in their brain about what Texas boys look like and, what they do and don't do. But can you just walk us through a little bit of the IRC codes, the main ones, and then, like the lineage? My understanding is a lot of the stuff got enacted in '86 when they were trying to encourage drilling.
Mm-hmm. Yeah, there's a couple of there's 2 main codes. One is the intangible drilling deduction. If it's domestic, and what that states is if you're investing in developing minerals within the United States, you can take 100% of your intangible drilling costs as a write-off the first year. What that means is, if I spend $10 million on a drilling venture, intangible drilling cost, I can take that $10 million and write it directly off my books as a loss that year. So instead of paying tax on 10 and I'm left with 6 million, I end up taking that entire 10 and investing it, and I've got no tax consequences to pay on that profit that I would have had if I haven't invested it. So that's one part. Now, is the money comes back, of course, it gets taxed, but it doesn't get taxed at 100% rate. The other part of this is called small producers depletion allowance. Back in the 80s, they did some studies when they were trying to increase production here in the U.S. And what they discovered is the majority, now this isn't the same now, but back then, the majority of the production in the United States was produced from something called a stripper well. The stripper well is a little well that produces less than 10 barrels a day. The problem with a stripper well is you're barely breaking even. At if your well's making 10 barrels a day and you have any problems with it, if it goes down, it's going to take 3 or 4 months just to get back to into the black. So they wanted to encourage these small companies, not Exxon and Mobil and Texaco and all of this. They wanted to encourage these small companies to keep all these little wells running. So what they enacted is a small producers depletion allowance. And what that says is 15% of your gross income from a well that's considered a stripper well is non-taxable. Okay, so you had to be a small producer. What a small producer they defined as is any producer that was producing less than a total production with everything they own of 1,000 barrels a day. Now these Eagle Ford wells alone do 1,000 barrels a day. So EOG or Conoco or Texaco or whoever drills just one of these wells, not every well they own, just one. Well, it's going to be over 1,000 barrels a day. If that's the case, it doesn't apply to them. Now, when we put this package together, when you look at the tax code, any working interest owner is considered a producer. So what that does, it goes back to him, is if he owns 1% of this program, then his 1% has to be over that 1,000 barrel a day threshold for him to be, excluded from that tax benefit. So all of our clients, when we put this program together, they're put in as active owners. They're indemnified from things going wrong. We've got insurance and all of that. So there's a lot of protections for liability with the clients. But from a tax standpoint, it's active. It comes off of their ordinary income tax. The write-off does, the IDC code. And then the depletion's the same way. So when it comes back to them, the income comes back to them, they're able to take a 15% deduction on gross income with no tax consequences. So, we'll have clients that will come in and they'll invest whatever they're comfortable with. Let's say they do, $300,000 the first year. Well, they get to take that 300. Most of that 300 is a write-off the primary year. So that's going to put their out-of-pocket somewhere in 180 range, maybe, for a $300,000 investment because they get that tax write-off. The next year, let's say these 3 wells produce half of that. They've produced 150,000. Well, 15% of that 150,000 they get to put straight into the pocket. So $17,500, whatever that is. They get to take with zero tax consequences. If the rest is rolled in, it's written off again. And the third year, those 4 wells, now he's got 4 wells producing. Those 4 wells will produce enough, hopefully, to drill 1 more or maybe 2 more wells. And it's the same process. So at some point, if these wells continue to produce and the rate of return is what we look for it to be, they're broken even by their original investment, which we calculated is about 180 just then of the 300, just with a depletion allowance. And then now they've got 15 properties producing for them. So that's kind of the goal. It's kind of like pushing a snowball downhill, right? It starts to gain speed, and then you get to the point where it just continues to roll. We have clients now that have been, they've been rolling with us for other 100 programs in a row. And, they're just sending back the revenue that is generated by the wells they own, and it continues to grow. So it takes a while to get there, but that strategy works where with the older wells where you're worried about dry holes, it wouldn't get there. The negative to the Eagle Fords is they're extremely expensive. The positive to the Eagle Fords is they produce very well. They last a long time. And risk-wise, they're one of the safest formations that you can drill into.
Right. Well, let's talk a little bit about fracking, because I'm not sure that everybody that's listening really knows what fracking is, and I think that they probably have a lot of environmental bells and whistles that go off in their head because they've heard certain things. So, can we talk about a little bit about the lineage of that, and then also how it plays into water tables and all the concerns that people normally have?
Everything that they think they know about fracking is wrong. It's totally wrong. It's like watching Landman. Okay, it's all fictitious. Most of it is just meant to generate a response from people. The news media likes to do that sometimes, all the times. But the way fracking works is, the Eagle Ford, for instance, we're pumping fresh water, not salt water, not acid, not nuclear reactive anything down into the formation to just break it open. We're trying to create porosity where there's cracks that the oil and the product that's in the formation can flow and come to the wellbore. When we're worried about the freshwater table, these wells, and again, we're talking about South Texas here, this formation. We have one of the deepest freshwater tables in the United States, which is the Carrizo, that goes down, how deep is about 4,000 feet. So everything below 4,000 feet is salt water. You're not drinking it. It's not drinkable. So that's what we have to protect. When we drill these wells, we will drill down through the water table, down past 4,000 feet, and this is all regulated where you have to set your surface casing. And then we'll put a 9 5/8 piece of pipe in the hole, cement it in, down past the freshwater table. So nothing that ever happens, and that's drilled with fresh water in the first place. So now you have your freshwater table totally isolated. From that point, most areas in the Eagle Ford, you don't need intermediate. So we'll drill another hole through the middle of that. We'll go all the way through the lateral to 20,000 feet or whatever it is, counting the horizontal leg. And then we set a piece of 5.5. I say one piece, 20,000 foot, a set of 5/8 case or a 5.5-inch casing, and cement that to surface. Now the Eagle Ford formation is it's on average, I'd say it's about 10,000 feet in South Texas. The freshwater table is at 4,000 feet. Now, when we're fracking these wells, everything is behind pipe. Okay, so there's no way to get into the freshwater table from the wellbore. It's going to have to be seepage from the formation. On top of the Eagle Ford, you have a formation called the Austin Chalk, which is a 700-foot thick solid limestone shelf. So we're fracking a 10,000 foot, sometimes 11,000 foot deep, a section of rock. When we frack this, we're looking for the frack to extend from the wellbore, maybe 150 feet in each direction. Okay, that's all the power that you're giving it. That's as far as it's going to go. 150, maybe in some areas you'll get 200 feet in each direction. Well, a lot of people think that this is going to contaminate the freshwater table. So when I'm pumping something that has a certain amount of fluid that we're looking to go out 150 feet in each direction, it's impossible for that to permeate 700 foot of solid limestone and travel 6,000, 7,000 foot through all these various rock formations to get to the freshwater table. It's impossible. It can't happen. Now, if we were fracking areas that were within the water table, okay, I can make an argument there. If let's say there was some formation sitting right on top of the Carrizo at 3,800 feet, and we go in there and we put a big frack on that, I could see that getting into the freshwater table. But down here, it's not the case. That's not what happens. And these fracks, we're fracking it with fresh water. So, yeah, you'll hear a lot about, I've heard many times about fracks causing earthquakes. I'm sure you've heard that. In Oklahoma, they had this bunch of earthquakes because there's a bunch of drillers out there. That wasn't even the fracks. That was water disposal. The state's in charge of where they dispose of not just frack water, but any water produced from oil and gas, they pump it back down into the formations in different wells. And, it's put back in there based on what the state ordinance requires. Well, if the state's making mistakes and they're having them put too much water in areas that are near fault plains, it could cause some things like that, but it's got nothing to do with fracking.
Yeah, so Lee, I think most of these projects you're talking about are multi-well projects, right? So how do you think about how close you put the fracking, I don't know what you call them, the stages, the wells to each other? Because you mentioned like 150 or 200 feet is about how far the fissures from the explosions and things like that are going to happen. How do you guys think about that in general? And I guess how does the industry think about it?
It depends on the area. Some areas warrant if the Eagle Ford is thicker, the sweet spot's thicker. They might have spacings from well to well down to 250 feet. I've seen them as tight as 120, but that was early. Our fracs are bigger now, so we don't have to worry about that. Some areas will warrant 300, 350 foot apart, which is pretty tight. Some are 500 foot, some are 750 foot. It just depends on what you think your frac coverage is going to be. Because the last thing that we want to do is rob from Peter to pay Paul. Like if I can drain efficiently 700 acres with 4 wells, well, I would rather do it with 4 wells than 6.
Right.
Because 6 wells are going to cost me another, $12 million. So that's the key. And where the Eagle Ford is really gone, and where the rate of return is in the Eagle Ford, we can't affect oil prices. They are what they are. But the advancement has been more along the lines of cost management. If I drill 4 wells at the same time versus 1, it's much more efficient because I've got the same equipment out there. I've got one pad. It's easier on crews. It's easier on rental equipment. It definitely saves money. It gives me some benefits too when I'm producing. And lateral length is the same thing. For instance, if I have a 5,000 foot lateral, I'm drilling down 10,000 feet and I'm turning, I'm going 5,000 feet out. I've got a set cost. If I drill 10,000 feet out versus 2 5,000 footers, well, I've only got 1 vertical hole versus 2. I've got the same amount of exposure to rock in the 1 10,000 foot well as I did into the 2 5s, but it probably saved me 30%. So it's more in the future, morphing to how efficiently and how well can we control cost, which increases our rate of return.
Okay. So now we got everything fracked. So I think the next stage is we got to have the flow back, and we got to get the oil out of the ground. So can we talk a little bit about that and how you monitor production levels and what's involved in separating the oil from the gas, and basically how do we get the oil back up out of the ground at this point?
At that point, you just open the spigot. Now, there's a bunch of equipment, of course, on the surface, to handle the pressure and handle the fluid and where it's going. Now, when you first open a well up, you're very overpressured because we just frack the well. We pump, 10,000, 11,000 pounds of pressure in it. So your flowing rates are really high. For the first, 30, 45 days, they're going to be high. So we will have a crew on site 24/7 to monitor the flowback. Once the well calms down and it's more manageable, then we have surface facilities. Those are probably already installed, but surface facilities get hooked up and calibrated, where the oil and the gas and the water coming out of the wellbore goes into a separator. The separator sends the water to the water tanks, the oil to the oil tanks, and the gas down the gas line. And then we have a what's called a gauger go out every day, check the well, make sure everything's fine, measure the tanks, lets us know what the oil tanks, if it did in oil production yesterday, what it did in water, and what it did in gas. Now, some areas, if you have multiple wells, you can set up some, electronic metering equipment where you can check on your phone or your computer or whatever, and it'll tell you what well is doing on a real-time basis. Most wells don't need that. If I'm to the point where I'm needing that, I've got a flowback crew out there. So once you get them up and running, we want somebody to go out there and check it every day, just in case there's a problem. If there's something leaking, if there's something that doesn't look right, if the well goes down, then they call back to the engineering at the office and say, hey, the compressor shut down, or the separator's full of sand. We'll send a crew out there to fix it.
Okay. So now you got the oil back up to the surface, and how do we get it to market? What does that process look like? And then can you just walk us through maybe a timeline of an overall project?
The to market, most of the time, the bigger companies will have oil pipelines. The bigger companies in some areas, if they have a lot of production, and they're just putting oil into the pipeline, and then the oil goes to the refinery. In the vast majority, they go into tank batteries, and then the buyer picks it up at the tank battery, sends a truck out, drains it out of the tank, and then takes it to market, takes it to the refinery. When a buyer picks up oil, as soon as it hits their truck, it's theirs. It's their responsibility. If they crash on the road, we've got no liability whatsoever. So it's we take it out of the ground, we put it into our tanks. When it leaves our tanks, it's sold. It's theirs. Phillips 66 is who we sell most of our oil to. Not always, but we can vary that contract if it helps us financially. But they've done well. We let them know how often, how many trucks, when to do pickups, things like that. The end of the month, they send us a check on how much oil we've sold, and it normally takes 45 days to get paid. For instance, production that we sold in December, we'll get a check on about the 15th of February.
Okay. All right. Yeah. So a normal project, if, from an investor's point of view, from investment stage to when they get paid, if they were to invest in one of your projects, is roughly how long of a process? I know it depends on the size of the well and some different things, but what does it just like a normal timeline look like?
Yeah, it's from the time the client purchases. You've got the funding process where we're placing people in the program. That normally takes a couple of months. After that, we've got to drill it. If it's a 2-well versus a 4-well versus a 7-well program, that's going to vary the time, of course. So, let's figure 14 days, which is a really good clip per well. If we've got 4 wells out there, you're looking at 2 months of drill time. So you've got 2 months of funding, 2 months of drill time. After the well is drilled, we call for the completion phase, which takes another couple of weeks. And you're probably looking at close to a month, 3 weeks maybe, of fracking before we start flowback. As soon as we start flowback, we're seeing product, or very soon thereafter. That product's going to be 45 days until the client's going to see a check. So 2, 3, 4 months. There's 5, about 6 months. From
6 months roughly.
Yeah, and that's if they're the first ones in. From writing a check to receiving a check, it'll be about 6 months. Sometimes it's quicker than that, but generally that's start to finish. That's a pretty solid timeline.
Okay. So Lee, what innovations do you see in the industry? Like, what are you excited about over the next however many years?
Technology-wise, I'm not really seeing much. I'm not. What we've seen out in the field is we've got a lot of larger companies picking up the medium-sized guys, and they're more disciplined. So I see a stable oil price from that. Conoco's got so much in the Eagle Ford now, and they're not going to drill. They're not. They would rather drill half as much at $78 than overproduce and oil drop to 60 where they're barely making a profit. So I see that going on. as far as technology changing in the field, I don't really foresee a lot. There'll be some efficiency improvements here and there, but I don't see a lot changing from a frac standpoint or from a drilling standpoint. I don't. We're seeing the drilling rig count continue to drop. We're seeing the frac crew count continue to drop. So, we're not ramping up. I say things are slowing down. We are producing more per well now on a new well than we used to. But again, I don't see supply increasing at any drastic rate anytime in the near future.
All right. Well, I know that a lot of the listeners probably are thinking about green energy and, nuclear energy and alternative forms. So they hear a lot about this in the news. I mean, what do you see domestic oil production? How do you see that playing into our energy future and like how it plays out, worldwide?
Well, oil has a built-in inflation factor, okay? And so does every other type of energy. Um, you know, Nuclear, I agree, for electricity is great. When you're talking about solar, when you're talking about wind, they're not efficient enough. They're not. They don't make enough for the cost to make them viable at this point. If you take away the artificial incentives from the government, it shouldn't even be in the conversation, to be honest. But what will change that is oil prices. When we get to a point where oil supply gets less and less and less, demand keeps going up. Demand will keep growing because we keep, increasing the size of the world. We've got more people. We've got more people driving. We've got more businesses. It's not going to go down. Demand's going to go up. Supply is the problem. Us keeping supply where it's at, much less expanding it, is going to be difficult. So when oil prices get to be, they're going to inch up to, at some point, maybe not in our lifetimes, but you got $180, $200 a barrel for oil. Well, now a lot of these other forms of energy start to become efficient. At that rate, you'll see more solar and you'll see more wind, and hopefully by then they'll make them more efficient. That's the only thing that's going to transition us, to be honest, into a quote greener energy is the price. That's
Right.
it. Because you can. Go ahead.
Yeah. So what's the one thing you wish more people knew about the oil industry?
Well, what I've learned from dealing with CEOs in every type of industry out there is what I think I knew about every industry is so far from the truth. So I guess respecting what you don't know would be a wonderful thing if everybody could do, because it's real easy to you see it all the time on the news where you've got somebody sitting at a gas pump to a reporter complaining that that gasoline is $2.95 while they're holding a bottle of water that they paid $4 for. Okay? And oil is, you've got heavy state taxes at 60 cents a gallon. You've got exploration costs, you've got refining costs, you're trucking oil, you're trucking gas, you're refining it into gasoline, you're running that, it's and all of that, and it comes to a pump at $2.99 a gallon is incredible. I mean, it's absolutely incredible. But of course, nobody really sees all that. Nobody sees what it takes to put it to where it is, and the efficiencies that are in place to get it there. They think that, greedy oil companies are making all this money, and they just want to stick it to the consumer, where the vast majority of oil production is coming from private companies anyway. And sometimes their rate of returns or their stock price is doing well and their dividends are great. Other times it's the absolute opposite, and it's tanking. So once you level it out, it's pretty normal compared to most other industries. But oil and gas does have, most people will say, the highest highs and the lowest lows. For sure. Either, you can't drill fast enough, you can't sell enough oil because the price is great, or, it's the other way and you can't even make a profit. So it's managing chaos is what it is.
There you go. Well, hey, Lee, I'd really like to thank you for coming on today.
Absolutely. I enjoyed it.
Yeah, appreciate the time. And that's the Executive Connect podcast.
Thank you.